From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first weekend of December 2023. Checking the calendar, seems like we haven't had a Packer game in months. Well, that's changing this Sunday. The reigning world champion Kansas City Chiefs are coming to Lambeau with or without Taylor Swift. And the Bucs welcome the Atlanta Hawks to Fiserv this Saturday night. And also this Saturday, it's the Santa Cycle Rampage. That's where people dress up as Santa, jump on bicycles, and go bar hopping. What could possibly go wrong? Let's start with Orlando and get the Florida bashing out of the way. A Disneyland guest was arrested after stripping off all of his clothes on the ride It's a Small World. Well, that's not something to brag about. America First Republican Congressperson Marjorie Taylor Greene just released a new book. It was printed in Canada. Vladimir Putin pardoned a Satanist cannibal and then sent him to the Russian front in the war with Ukraine. I think that qualifies as a war crime. We all know one of the busiest shopping days of the year is Black Friday, the day after Thanksgiving. Did you know it's also the busiest day of the year for plumbers? Don't think about that too much. Canadian police are applauding a hefty jail sentence for a man who was caught driving despite being the subject of 9 lifetime driving bans. Now, for the understatement of the year, the cop says he showed little regard for the law. Really. And finally, our headline of the week. Overweight Chinese man's big belly saves him from falling down a well. Sounds like a job for Lassie. On the podcast today, we have Dave Sandstrom, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. And we want to be sure we don't miss the Marquette UW game on Saturday as well. Should be a big opportunity for your number 3 Marquette Golden Eagles to continue to prove that they're worth it.
Or the other way around.
Or no, we're gonna lean towards Marquette here. A good week overall for the markets, putting a cap on I think what was a pretty incredible month. Dow Jones Industrial Average up 2.4% on the week, up 855 points, closing at 36,245 on Friday. The S&P 500 up 0.8%. That's up 35 points for the week. And the NASDAQ up 0.3%, closing at 14,305 for the year. The Dow Jones Industrial Average up 11.6%, including dividends. The S&P up 21.5%, and the NASDAQ up 37.8%. Also worth pointing out the move significantly lower in the rate on the 10-year U.S. Treasury from a start of the week at 4.47 down to 4.23. We had touched as high as almost 5% in mid-October. And since, it's been quite the run for bonds. And, Dave, I think some of that comes on what has been a market expectation that an interest rate cut is coming. And when you listen to the Fed talk, and we had plenty of comments this week as the Fed kind of gets their final comments out before they go into their blackout period right before the December 12th meeting. And most of them were saying, hey, yeah, we think we're maybe near the end of the rate hike cycle, but don't count on cuts yet because we got more work to do. And yet, we're also dealing with what was the best market for bonds, the best month in basically 40 years. You got to go back to May of 1985 to see a return that was better than the return we saw on the Bloomberg Aggregate Bond Index in November. What's going on here with this idea that the market seems to believe maybe the rate cuts are in, the Fed a little more hesitant to commit to that?
I saw a great headline to kind of close the day today, and it said that both the stock market and the bond market are calling the Fed's bluff on this mantra that rates are going to be higher for longer. And it's going to be very interesting to see who is correct in the end. And obviously time will tell. I think there's just been some really strong indicators that the Fed, what they've been doing, the work they've been doing to bring down inflation is working. We're finally starting to see some weakness in the housing market a little bit. Joel's I don't want to steal the thunder in your indicators, but pending home sales hitting a 20-year low. So we always have known that the real estate market is a tendency to really lag in environments like this, the impacts of rising rates. A lot of the other inflationary areas have come down quite a bit since the Fed has started this rate hike cycle, and housing might be the last domino to fall. So we'll see what happens there. Time will tell on the Fed. And I think there's also, in the bond market, we spent a lot of time not making much money in bonds, right? And now that investors see that 5% number out there, like you mentioned in October, I think there was a lot of people that finally said, okay, I'm in.
Yeah, basically 75 basis points lower on the 10-year if all you did was buy an intermediate term bond. That 75 basis point move is probably worth 3 or 4% in price. And so the gains that we saw in bonds have been pretty substantial. Tom, one of the challenges I've faced in, my regular meetings with clients, and I suspect you're facing it as well, is remaining committed to that, that idea that bonds provide some ballast, to that idea that maybe the road ahead for bonds looks a little easier. Certainly I've set aside cash where appropriate, but, are you finding it challenging on occasion to have those conversations about, no, there still is some life left in the bond side of your portfolio?
Yeah, absolutely. I think it kind of goes back to the buy low, sell high mantra. And I think if I point out to people, and this has happened not only with stocks, but especially with bonds over the last couple of years, is, I think the last quote I saw was just, it's been the worst 2 years, a year and a half or so in bonds in 150 years, as far as performance is concerned. And, I kind of say these almost as shock value anecdotes, if you will. But the reality is that makes me optimistic that there's probably better days ahead, that we're at this trough. And at some point, it's just better days ahead. And, I think the other challenge we have in what we do is, we're meeting with clients and looking at things year to date. And that could be, or since the last meeting we may have had with them, and it could be 3 months, could be 6 months. And it's kind of marrying, looking at short-term data and performance and kind of what we see over longer term and kind of extrapolating that, because we don't want to react too quickly to things. And if we look at, bonds as they've been pretty terrible for a long period of time, I kind of have to put that expectation in that we're trying to play the long game here. This is a marathon, and I would expect much better returns, and kind of using some of the simple math that we talk about with duration and multiplying the interest rate movements times duration to find out what an average price movement might be within their bond portfolio, and say, okay, well, let's do a little scenario planning, and if rates do nothing, here's what happens. Here's the yield on your bonds, and this is what you can expect. And if you're optimistic, rates go down another 0.5%, well, multiply that by your duration, and that's the price movement you can expect to see. So it's a little bit of kind of going through that exercise to help set, I guess, a fairly realistic expectation, across the spectrum of what might happen.
And I think that bond math is so critical to those conversations. It helps potentially avoid missing out on what I think is a pretty meaningful opportunity in bonds. And yet, Dave, the Investment Company Institute coming out with some numbers that suggest that perhaps there is a large pile of cash on the sidelines that is missing out on the bond market. Some of it there for very obvious reasons, but also, maybe we're getting to a level where, that cash might be starting to find a better use.
I find it comforting, Kyle, to see that type of cash available. Now, I think people have been very content with making 5% in cash. Obviously, that's something that we haven't been able to discuss with clients and probably since the financial crisis, that you make that kind of money on a money market. So I think people have been very content with that, ride out some of the volatility in both bonds and stocks. And yeah, I'm happy collecting 5% on my cash. But it's comforting to know that it's there, because think about as time goes forward from now, short-term rates likely over time to come down. That gives us a lot of fuel, a lot of ammunition to put towards areas of the market that may look attractive, and that typically provides you with ballast and kind of some downside protection. If stocks look more attractive with some weakness in the future, you might have some support coming via that big cash pile.
And amid all this safe money conversation, bonds and cash and the like, we also I think need to mention just how strong of a month it was in November for stocks more broadly. As we record this, the S&P was pushing close to 4,600 for the first time since going back to late July. And prior to that, you got to go all the way back to 2022 to see it. And so, from a price perspective, we are still below the peak for the S&P, but we're certainly getting a lot closer after the run in November. And so for balanced portfolios, you didn't have the typical, it was a great month for stocks, but bonds took a little bit away, or it was an okay month for bonds, but stocks were terrible. The balanced investor looked at their portfolio at the end of October and said, what's going on here? They're going to see that same statement into November and go, oh, okay, never mind. I can wash out those last 3 months, and we're basically back to where we were at the end of summer. And I think, that's an encouraging place to be as we get into the last month of the year. It certainly makes our lives a little bit easier as we talk about, how do we rebalance from here? How do we reposition from here? We're doing it from maybe not the high water mark, but a much higher water mark than where we were before. And, Joel, amid all of this, we have a lot of conversation on kind of how consumers feel. And in particular, we got some economic data this week on kind of the consumer's opinion and a bit of a white paper from the Chicago Fed on maybe the broader kind of definition of what that really means for what we see out there in the economy right now.
Yeah, Kyle, the Fed did some research showing that their reliance on consumer sentiment and even business sentiment is off. That especially since the pandemic, that people seem to be a lot more pessimistic than the economic indicators would suggest, especially if you consider the tight job market, which generally means for consumers, you don't have to worry about losing your job as much. You don't have to worry about losing wages. In fact, that's a good time for wage increases, which we've seen, and that usually fuels consumer sentiment. But we still have numbers from both the Conference Board and the University of Michigan saying that sentiment is down, that people are pretty pessimistic, pretty gloomy about what the economy is, when in fact there are a lot of indicators that say they shouldn't be.
Yeah, what's interesting, and you mentioned before the show, is those indicators pointing towards recession, right? This expectation that we should probably have been in one already, depending on which of those kind of sentiment measures you're looking at. And yet, by all measures, the economy grew pretty markedly in the third quarter. Expectations for some continued modest, if not, respectable growth going forward. And so it is so interesting to me, and Dave, you have so many of these conversations with clients, I know that I do as well. They come in the office and they want to tell us, hey, what's going on? Things that are not great out there right now. I think that's true, certainly, depending on where you look. But then you have the broader conversation about, well, what are you seeing? What are you thinking? And more importantly, how does it impact what you're spending? And I think when you ask those questions, you maybe get a different answer from the first part to the second, right?
Yeah, it is kind of funny. And you bring up a great point, and Joel, in reference to your statement about the study, that it's not coinciding with what's really going on. People are pessimistic. They're negative, maybe even to a point in conversations, clients, and yet they're not changing behavior. As a matter of fact, if anything, I've seen an increase in spending and travel and leisure and splurging on vehicles or toys and boats and campers that is fueling a lot of economic activity despite what we're seeing as kind of a pessimistic attitude.
And Dave, some of that might be pent up still from the recession that we had, the short recession and the gloom that kind of followed that after the pandemic. Some of the numbers that I saw this week, for instance, showed that consumer spending, although from September to October it was the slowest month for spending since March, it also showed that that personal saving, reached a level of $769 billion, which sounds like a lot, but that's down from $1.3 trillion just before the pandemic, and it's down from $6 trillion back in April of 2020 when nobody could spend anything. And remember, the government was trying to infuse money into the economy so that people would spend some more. So there's some sign there that spending is starting to slow, but it's still going.
And, maybe one other area that has been so interesting to me, and Tom, it's something you and I were talking about earlier, is just watching energy prices, watching what's going on with OPEC, watching what's going on with some of these global conflicts. And, it's interesting, the one area of the market in November that didn't make money on at least a sector level was energy stocks. And then you've got OPEC, this week having conversations about what do we do. It's so interesting to me as part of the inflation conversation, right? Oil prices and in particular, prices at the pump are something that so many of us point to as, hey, it's inflationary. What are you seeing as you kind of look at some of those areas?
Yeah, I mean, I think it's one of the big surprises we've seen here just in the last month or two is, since the Middle Eastern war and conflict that's going on, people naturally expected oil prices or gas prices to go up. We haven't really seen that, right? I mean, oil prices right around $75 a barrel right now, bouncing around there. Now with announcements that the OPEC Plus nations are planning to cut supply or increase cuts to supply, but still the markets are not really reacting to that. We haven't seen a spike, and I think a lot of that has to do with some of the maybe disagreements and disjointed kind of beliefs on what is better for each individual country right now at the moment. So right now the market's just kind of telling us that, well, we'll believe it when we see it. And again, and not to mention the fact that the U.S. is producing as much oil as we've ever produced in our history. So these are all things that are leading to and keeping the gas prices, oil prices at a more reasonable level, and we haven't seen that shock that many people have feared.
It's fascinating to watch the course that oil prices have taken, isn't it, over the last couple of years? I mean, prior to the invasion of Ukraine by Russia, we were at about $75 a barrel, went all the way up to 150, doubled during the height of that conflict. And to your point, Tom, we're back down in the mid-70s again. It's incredible the change that has taken over that just a short amount of time.
Yeah, and I think it's so important to the larger conversation because, while gas prices specifically or oil prices, more broadly, are just a small sliver of the inflation basket, you add up what we've seen in the used car market, even in the new car market in some places, and more stable prices. You add in, a housing market that's seen some slowing in some areas, and certainly the housing prices don't translate directly to most measures of inflation, but they're going to make their way through. And you add in oil prices and energy prices that have been much more stable than they were. I think it's all part of the bigger picture we've been talking about of, inflation really is coming back down. It's not everywhere all at once. There's a lot of factors that play into it, as I think, Tom, you highlight with, kind of the OPEC conversation, and Dave, you highlight with kind of the war in Ukraine conversation. That's all noise that kind of underlies the bigger picture of what's going on with prices. But at the end of the day, you can look at the pretty hard numbers and go, if we're measuring the same thing month over month, year over year, what's inflation actually look like? It has been coming down. Joel, maybe the last thing I'll mention is a newsletter that's on its way out. A good article from you talking about maybe some fear of when to claim Social Security and how that might weigh on our decision making, maybe leading us to choose to claim a little earlier than what might otherwise make sense.
Yeah, again, looking at researchers and what they've found about people reading headlines about the Social Security Trust Fund and believing that there's an expectation that that's going to be insolvent, technically, by 2033, and a fear that means that there won't be any more Social Security. So I better take my benefits now rather than doing what most of us understand, according to the research, and that's to delay taking benefits because the payments go up. So, so I wrote an article about that to basically say, even if the trust fund becomes insolvent, 80% of Social Security benefits should be covered. So people shouldn't be afraid just to hang in there and take Social Security when it benefits them. They should look beyond those headlines. And then there's also a piece that you wrote looking at stronger tools that are out there for investors now that help them be more patient and withstand some of the volatility that we've seen in the markets.
Yeah, and I think November was the perfect lesson for why we need those tools, and maybe what one of those tools isn't, which is market timing, right? This idea that, well, if all I do is miss out on 3 days in the month of November, I've missed out on probably 30 or 40% of the return for the S&P this year. It doesn't take being wrong for long to miss out on some of the best. And, maybe to bring it back to the earlier conversation on how we feel about the market, it came at a time in which, consumers, investors weren't feeling all that great to begin with. And so really critical, I think, that we, continue that balance, continue that kind of diversified approach that we take as a way to say, no, this protects us from being wrong in a big way. Be wrong in lots of little ways, it's not going to cost you all that much. But if you're wrong in a big way and out of the market for, that short period of time, it can be detrimental to your year's return. With that, we enjoy doing the program for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.